The perennial debate between real estate and the stock market often feels like a religious war, with each side claiming the ultimate path to financial freedom. To settle this, let's look at two hypothetical investors, Ethan and Liam. Both have managed to save $50,000. Both earn a steady $55,000 annually, and both are starting from the same financial baseline in the same city. However, their philosophies on money are diametrically opposed. Ethan believes in the tangible power of dirt and bricks. Liam believes in the silent efficiency of global commerce. The tangible asset, Ethan's real estate journey. Ethan decides to go all in on a rental property. He identifies a solid 3-bedroom suburban home priced at $250,000. Using his $50,000 as a 20% down payment, he secures a 30-year mortgage at a 7% interest rate. After accounting for principal and interest, his monthly obligation to the bank sits at approximately $1,330. On the surface, the math looks incredible. Ethan quickly finds a reliable tenant willing to pay $1,800 a month. In his mind, he is clearing $470 every single month. He feels like a titan of industry. He has a physical asset he can drive past, a tenant who is essentially paying off his debt, and a narrative of passive income to share at dinner parties. This is the power of leverage. Ethan is controlling a $250,000 asset with only $50,000 of his own capital. If the home value rises by just 3%, he doesn't just make 3% on his $50,000, he makes a 3% gain on the full $250,000 value, effectively a 15% return on his actual investment. The invisible engine, Liam's market strategy. Meanwhile, Liam takes his $50,000 and quietly moves it into a low-cost, total stock market index fund. He doesn't have a house to show off. He doesn't have a tenant. What he has is a brokerage login and a diversified slice of the world's most profitable companies. To keep pace with Ethan's effort, Liam sets up an automated monthly contribution of $300. For the first few years, Liam's life is remarkably boring. While Ethan is talking about doors and equity, Liam's co-workers barely understand what an index fund is. His wealth is just a fluctuating number on a screen. He has no leverage, no tax-deductible depreciation, and no one is paying his mortgage. In the social hierarchy of hustle culture, Liam looks like he's standing still. The reality check. The hidden costs of ownership. Fast forward 3 years. Ethan's napkin math of $470 per month in profit is beginning to crumble under the weight of reality. While he collected nearly $65,000 in rent, the invisible costs of real estate have emerged. The tax and insurance bite. Property taxes and homeowners insurance have siphoned off $4,500 annually. Maintenance chaos. A water heater failed, $1,200, and a section of the roof needed emergency patching, $2,800. The vacancy trap. One tenant moved out, leaving the unit empty for 5 weeks. Between the lost rent and the costs to deep clean and relist the property, Ethan lost over $2,400 in a single month. When Ethan calculates his actual net cash flow after 3 years, he hasn't made $17,000. He has barely cleared $3,000 in total cash profit. More importantly, he hasn't factored in the sweat equity. Every plumbing emergency at 10 p.m. and every weekend spent screening tenants is a withdrawal from his most precious resource, time. In contrast, Liam's $50,000, plus his steady contributions, has grown to roughly $76,000, assuming a standard 10% market return. Liam has spent 0 hours on this investment. He hasn't answered a single phone call or dealt with a single contractor. His wealth is liquid. He could sell it tomorrow with the click of a button. Ethan's wealth is trapped in the house. To get it out, he'd have to pay a realtor 6% and wait months for a closing. The midterm horizon, 10 years in. By year 10, the trajectories begin to diverge sharply. Ethan's property is appreciated at a modest 3.5% annually and is now worth roughly $350,000. Because he's been paying down the mortgage, his equity, the portion of the house he truly owns, is approximately $180,000. He is, by all definitions, a wealthy man. However, he has also spent the last decade as a part-time property manager. He has replaced a roof, upgraded an HVAC system, and navigated the emotional stress of 2 bad tenants who were late on rent. Liam's portfolio, through the sheer magic of compound interest, has swelled to about $175,000. His original $50,000 and his $36,000 in contributions have done the heavy lifting. He is roughly equal to Ethan in net worth, but his path was paved with silence and automation. Liam has diversified his risk across thousands of companies, while Ethan's entire fortune is tied to one single building in one specific neighborhood. If a local factory closes or a school district declines, Ethan's investment suffers. Liam is immune to local shocks. The 20-year finale. Zeros versus hours. At the 2-decade mark, we see the true cost of each choice. Ethan's home is likely worth $500,000. If he hasn't refinanced, his mortgage is nearly gone. He has a massive asset that produces significant monthly cash flow. But over 20 years, Ethan has essentially worked a second job. He has managed renovations, argued with insurance adjusters, and carried the mental weight of a $200,000-plus debt for 2 decades. His wealth is impressive, but it was earned through labor and risk. Liam's portfolio has hit the vertical part of the compound interest curve. At a 10% average return, his account is sitting near $450,000. If Liam had found a way to increase his monthly contribution from $300 to $500, perhaps by using the time he didn't spend fixing toilets to advance his career, his portfolio would be closer to $600,000. The zeros, compounding, eventually beat the hours, active management. The blind spots, why one side usually lies to you. To be fair, both strategies have dark sides that their proponents often ignore. The case against the market. Liam had to endure the psychological torture of volatility. In those 20 years, he likely saw his account balance drop by 30% or 40% at least twice. Watching $150,000 turn into $95,000 in a single month is enough to make most people panic and sell at the bottom. Stocks offer no forced savings mechanism. If you stop contributing or withdraw money during a slump, the math breaks. The case against real estate. Real estate is a business, not an investment. If you treat it like a set-it-and-forget-it asset, you will lose money. You are exposed to idiosyncratic risk. A pipe burst, a lawsuit from a tenant, or a change in local zoning laws can ruin your returns. Furthermore, the tax benefits, like depreciation, are fantastic. But they eventually have to be recaptured when you sell. Unless you use complex strategies like 1031 exchanges to kick the tax can down the road forever. The conclusion, the only question that matters. Ethan and Liam both succeeded, but they purchased different lifestyles. Ethan bought a vocation. He used leverage to build wealth, but paid for it with his time and stress. Liam bought freedom. He accepted market volatility in exchange for a passive existence and total liquidity. The real estate versus stocks debate is usually framed as a search for the highest percentage return. But that's the wrong metric. The real question is, what are you willing to trade for your wealth? Are you willing to trade your Saturday mornings for a 2% higher return through leverage? Are you willing to trade the security of a physical asset for the volatility of a digital ticker? Are you accounting for the zeros of compounding or just the rent check on the surface? The most dangerous trap isn't choosing the wrong asset. It's choosing an asset based on a success story without looking at the ledger of hidden costs. Before you buy the house or the index fund, ask yourself if you've counted everything: the taxes, the time, the risk, and the opportunity cost. Because in the end, the math doesn't care about your feelings. It only cares about the truth.